Bank Julius Baer and Company is now joining us to take some questions. Mark, great to have you with us here. Thank you very much for your time. I just want to start with the China question. Do you think the Chinese economy reopening, refocusing on growth in that sense, lots of headlines around that, it could, in a way, reintroduce some more competition for portfolio flows and on the economy side as well for India? What's your sense?
My sense is yes. This reopening is much better than even the most optimistic expectations, and therefore there will be a rebalancing back into China. So I don't disagree, and I do think that China, as well as some of the other markets that got beaten up badly this year, like Korea, like Taiwan, will outperform India next year. Because of China reopening, and also because we'll probably hit a cyclical bottom in the world economy sometime next summer. And those more cyclical type of markets tend to move about 6 months in advance of the actual event itself, which means around now they should be starting to reflect the better news in the second half of next year.
Mark, morning, Rima here. So shouldn't China reopening also drive up demand expectations from crude? Crude is moving in the reverse direction, right? It continues to slide lower. Shouldn't there at least be a sentiment uptick in crude prices because of China reopening? What's happening in that market according to you?
My sense is there is a lot of crude oil flowing around the world, and the price caps that the Europeans imposed on the G7 imposed on Russian oil don't really mean anything, because Russia's largely reoriented its oil trade to our part of the world. So the main thing is there's lots of oil. But I'd also say that I don't think it's going to go down much more below where it is now. I certainly wouldn't see it below 70, because the U.S. Strategic Reserve needs to start rebuilding. It's practically at zero. They need to, and it's a wonderful time to be buying it around this price.
Hi, Mark. Morning. What about asset allocation, Mark? There are growing concerns about inflation, about recession as well. Maybe the Fed doesn't take their leg off the pedal so soon. How would asset allocation shape up with 2023 in mind? More money goes towards fixed income rather than equities?
I think it'll be a good year. It will be volatile, but we just had such a bad year because of the things that you talked about that I think they're largely imbued in prices by now, with the NASDAQ, for example, down 30% and the S&P's down about 17 or 18% year to date. And of course, the bond market having much worse performance relative to its history. On the recession, if there's one, it'll be very mild, because we can see the service sector in America is incredibly strong. You would have seen the ISM service PMI that came out on Monday, and the prices paid within that PMI very strong. And the labor market is also very strong. We got that on Friday last week. So, if there's a recession, I think what's the difference between minus 0.2% and plus 0.2% growth? There is none. It'll be one of those recessions that you hardly notice. And as for inflation, it will come down very fast. And the Wall Street Journal published a piece on Tuesday where it spoke extensively about the lag between market prices for the housing market and the actual housing data that is reflected in the Personal Consumption Expenditures Index and the Consumer Price Index. There's a huge lag. If you use today's market prices for housing in the U.S., core CPI would not be at 6.3%. It would be around 3%. And the Fed knows that. I think there's room for optimism next year, plenty of room for optimism.
Plenty of room for optimism. Mark, we had someone from Goldman Sachs, and we'll play out some sound bites of them later on in the show. Their point was that you could see another 10-15% kind of move in China offshore stocks. I mean, those listed in Hong Kong and US, etc. But beyond that, right, it's kind of difficult to imagine a kind of very structural up move through the rest of 2023. So it's at best a tactical kind of a thing, Mark. So I just come back to my earlier point. Are we talking about temporary underperformance? And you've been making that point, India vis-a-vis China.
Well, I think it'll last more than 6 months, actually, the China trade. But long term, absolutely. I mean, I like India for the rest of my life. I like China maybe for the next 12 months. And I think it comes down to the fact that India is pro-capitalist, pro-business, and China, at least in the recent years, is the opposite. Ultimately, what moves share prices is the money that the companies make. And in China, the state is becoming a larger part of the economy, and managers of state-owned enterprises do not have in their job description to create good returns for shareholders. But in the private sector, they certainly do. So there are two economies that are moving in opposite directions. In India, the state is becoming a smaller part of the economy, and in China, it's becoming a bigger part. And so that's, if I had to pick just one reason, there's others as well, like demographics, and there's several other reasons, actually. But long-term India, for sure. And you can just look back in history, by the way, over the last 30 years, India, in dollars, including dividends, has returned 9% per year. China returned 0.7%. That is and yet China's economy, you know, went from 500 billion to 18 trillion over that same period of time. I think India's went from 2 to whatever your economy is today now. I'm not sure. So anyway, I don't want to ramble, but next 12 months, China will outperform. Beyond that, India is the way to go.
Mark, pleasure speaking with you today. Thank you very much for joining in. China is a tactical buy for the next 12 months, but structurally bullish on India for life. That's the opinion coming in from Mark Matthews. Get into a break. On the other side, our list of top 10 stocks is lined up next.